Underapplied and overapplied overhead. As you have learned, overhead refers to the indirect manufacturing cost. These are manufacturing costs other than direct materials and direct labor. Since overhead costs contribute to the production of inventory and are incurred throughout the production process, they must be allocated to each job. This means management can't wait until the end of the period to add up all of the overhead costs incurred and allocate them to each job. Instead, management needs to estimate the future overhead costs and allocate them throughout the production process. The actual overhead refers to the indirect manufacturing costs actually occurring and having been recorded. These include the manufacturing cost of electricity, gas, water, rent, property tax, production supervisors, depreciation, repairs, maintenance, and more. The applied overhead refers to the indirect manufacturing costs that have been assigned to the goods manufactured. As you know, manufacturing overhead is applied using a predetermined annual overhead rate. The over or under applied manufacturing overhead is defined as the difference between manufacturing overhead costs applied to work in process and manufacturing overhead costs actually incurred during the period. If the manufacturing overhead cost applied to work in process is more than the manufacturing overhead cost actually incurred during the period, the difference is known as over-applied manufacturing overhead. On the other hand, if the manufacturing overhead cost applied to work in process is less than the manufacturing overhead cost actually incurred during the period, the difference is known as underapplied manufacturing overhead. The occurrence of over or underapplied overhead is normal in manufacturing businesses because overhead is applied to work in process using the predetermined overhead rate. As you know, the predetermined overhead rate is computed at the beginning of the period using estimated information on total manufacturing overhead and the estimated amount in the activity base. The PDOR is then used to apply manufacturing overhead costs throughout the period. Since the future cost and future number of machine hours or direct labor hours are not known with certainty, and since the actual machine hours or direct labor hours will not occur uniformly throughout the year, there will always be a difference between actual overhead incurred and the amount of overhead applied to manufactured goods. Hopefully, the differences will be minimal at the end of the accounting year. Actual manufacturing overhead costs are debited and applied manufacturing overhead costs are credited to manufacturing overhead account. Actual overhead costs are debited as they are incurred, and applied overhead costs are credited as they are applied to the work in process. At the end of a period, if manufacturing overhead account shows a debit balance, it means the overhead is underapplied. On the other hand, if it shows a credit balance, it means the overhead is overapplied. This is all better understood with a couple of examples. Let's look at an example of an overapplied overhead case first. Paul Diaz uses a predetermined overhead rate based on direct labor hours to apply manufacturing overhead to jobs. The assumptions are that estimated direct labor hours are 100,000, actual direct labor hours are 110,000, actual manufacturing costs are 190,000, and estimated manufacturing overhead costs are 200,000. To solve this problem, first we must determine the predetermined overhead rate. The predetermined overhead rate, again, is estimated at the beginning of the period, and in the numerator, it includes the estimated total manufacturing overhead costs, in this case, 200,000. The denominator is the estimated total units in the allocation base. In this case, it's 100,000 estimated direct labor hours. Dividing the 200,000 by the 100,000 gives us a PDOR of $2 per direct labor hour. Next, we determine what the applied manufacturing overhead cost is. We take the predetermined overhead rate of $2 and multiply it by the actual direct labor hours, 110,000, and get a manufacturing overhead applied of 220,000. This number will join direct materials and direct labor to get the total cost for the product. Next, we'll determine whether the manufacturing overhead was over or under applied. The actual manufacturing overhead for the period was 190,000. Our applied manufacturing overhead was 220,000. We had applied more overhead than we needed to. As a result, we are over applied by 30,000. If we're over applied by 30,000, it means that we have too much cost for the period. At the end of this period, the balance in the manufacturing overhead account needs to be cleared out. Being cleared out means the balance needs to be disposed of either by allocating it among work in process, finished goods, and cost of goods sold accounts, or by transferring the entire amount to cost of goods sold account. Because manufacturing overhead is a clearing out, its ending balance must be zero. In our example, we transferred the entire amount to cost of goods sold. And you'll see at that point that our manufacturing overhead account is zero, and we've adjusted our balance for our cost of goods sold. Now let's take a look at an example of an underapplied manufacturing overhead. Bezos Corporation uses a predetermined overhead rate based on direct labor costs to apply manufacturing overhead costs to jobs. Notice their PDOR is based on direct labor costs. It's not based on direct labor hours or machine hours, it's direct labor costs. So then we have a schedule that shows the direct labor hours, the estimated amount, the actual amount, the direct labor costs, estimated amount, actual amount. Manufacturing overhead, estimated amount, actual amount. So the first thing we need to do again is figure out what the predetermined overhead rate is. Predetermined overhead rate again is estimated manufacturing overhead divided by the estimated amount in the activity base. The estimated amount for the overhead was 200,000. The estimated amount in the activity base is 400,000 because 400,000 is the estimated direct labor cost for the year. The PDOR is 50%. 200 by 400,000 is 50% or 0.5. Now to figure out the manufacturing overhead applied, we take 350,000, which was the actual direct labor cost incurred for the period, multiply it by 50% or 0.50, and we get $175,000. The 175,000 represents our applied manufacturing overhead for the period. Now let's look at it in comparison to what actually occurred. What actually occurred was 220,000 of overhead. But we applied 175, so we are underapplied by a total amount of $45,000. In the T account to the right, you'll see that. On the debit side, we have an actual amount of 220. On the credit side, we have an applied amount of 175. So we have a debit balance of 45,000. That's our unadjusted balance because we're going to make an entry here. We need to zero out that account. Well, if we have a debit balance of 45, the only way we can zero it out is by crediting manufacturing overhead. Then we have to debit something. Well, we can either debit cost of goods sold, or we can allocate it to work in process, finished goods, and cost of goods sold. Again, I chose to transfer the funds to cost of goods sold. So now to the left, you see the journal entry. We debit cost of goods sold for 45,000, which actually increases our expense for the period, and we credit manufacturing overhead for 45,000, which zeroes out that account. At this point, we've corrected our books. Done. Now let's complete a problem demonstrating the proportional allocation of over-applied manufacturing overhead to the work in process, finished goods, and cost of goods sold accounts. J. Paul Inc. has provided information on the amounts for direct material, direct labor, and manufacturing overhead in its work in process, finished goods, and cost of goods sold accounts. The total balance for the work in process account is $15,500. For finished goods, it is $37,500, and cost of goods sold is $153,000. The total for the three accounts is $206,000. For this problem, the manufacturing overhead over applied is given at $10,000. Since it is given, there is no need to calculate the predetermined overhead rate or to apply it. The problem states that the allocation of any underapplied or overapplied manufacturing overhead is based on the manufacturing overhead applied in each account during the period. We need to determine the adjusted balances for work in process, finished goods, and cost of goods sold after the allocation is completed, and then record the journal entry needed to update the account balances. Problems like this are best solved by developing a schedule. Our schedule includes columns for work in process, finished goods, cost of goods sold, and the total amount for the three accounts. Our first step is to bring down the total unadjusted balances for the three accounts. We have $15,500 for work in process, $37,500 for finished goods, and $153,000 for cost of goods sold. The total for all three accounts is $206,000. Next, we need to determine the allocation percentage for each account by dividing the manufacturing overhead applied for each account by the total applied of $48,000. The allocation percentage for work in process is $6,000 divided by $48,000, or 12.5%. Finished good is determined by dividing $12,000 by $48,000 to get 25%. And cost of goods sold is $30,000 divided by $48,000, or 62.5%. The sum of the three accounts must be 100%, as shown. We now multiply each percentage by the manufacturing overhead over applied. For work in process, 12.5% of $10,000 is $1,250. Finished goods is 25% times $10,000 or $2,500. Cost of goods sold is 62.5% times $10,000 or $6,250. Adding the three accounts gives us a total of $10,000. We have allocated the over-applied amount. The adjusted balance is determined by subtracting the allocated amount from the prior balance because the prior balances had too much cost in them. The adjusted cost for work in process is $14,250 as we subtract $1,250 from $15,500. Finished goods is $35,000 or $37,500 minus $2,500. Cost of goods sold is $146,750 as we subtract $6,250 from $153,000. Adding across gives us a total cost of $196,000, which is $10,000 less than the $206,000 that was in the unadjusted balance. The final step is the compound journal entry. Remember, simple journal entries have one debit and one credit. Compound entries have more than two accounts involved. Since we are over-applied, we need to debit the manufacturing overhead account for $10,000 to zero out the account. We then credit work in process, finished goods, and cost of goods sold to decrease the balances in each. The credits are $1,250 to work in process, $2,500 to finished goods, and $6,250 to cost of goods sold. The books have been adjusted with the allocation and now reflect the actual costs for the period. Had the problem involved the proportional allocation of underapplied overhead, we would have debited work in process, finished goods, and cost of goods sold to increase their balances, and we would have credited manufacturing overhead to clear out the account. That covers overapplied and underapplied overhead. To sum things up, the over or under applied manufacturing overhead is defined as the difference between manufacturing overhead costs applied to work in process and manufacturing overhead costs actually incurred during a period. If the manufacturing overhead cost applied to work in process is more than the manufacturing overhead cost actually incurred during the period, the difference is known as over-applied manufacturing overhead. On the other hand, if the manufacturing overhead cost applied to the work in process is less than the manufacturing overhead cost actually incurred during a period, the difference is known as underapplied manufacturing overhead. The occurrence of over or under applied overhead is normal in manufacturing businesses because overhead is applied to work in process using a predetermined overhead rate, which is computed at the beginning of the period using estimated information and is used to apply manufacturing overhead costs throughout the entire period. At the end of the period, the balance in manufacturing overhead account is disposed of by either allocating it among work in process, finished goods inventory, and cost of goods sold accounts, or by transferring the entire amount to cost of goods sold. This video has demonstrated both methods. Thanks for watching the video. Good luck.